This podcast is for informational and educational purposes only and should not be construed as investment, tax, or legal advice. Any examples or frameworks discussed are general in nature and may not be suitable for all investors. All investing involves risk, including the possible loss of principal. Past experiences and planning approaches do not guarantee future results. So when people talk about diversification, it's almost always related to investing. But there's another type of diversification that almost never gets talked about, which is tax diversification. What that means is that you have different assets with different tax characteristics that you can pull from when you want income or you want to sell assets, and you can do it strategically because you have different options of what the tax ramifications will be. So if you only have one type of tax situation to pull from, then you're really pigeonholing yourself. And I see this become a problem with a lot of people in one particular way, which is someone who is very focused on reducing their tax burden throughout their life, and they save up a fortune in their IRA. But when it comes time to pull the money out, they end up having to pay tax on everything. And if they accumulate a lot of money, then every dollar that they've saved and grown tax deferred is going to end up being taxed on its way out. And sometimes at a very high rate if you don't actually need the money and you're taking it out because of required minimum distributions. So it's a good strategy to have some money that will be taxed eventually because it is tax deferred, but also to have some tax-free buckets and money that is being taxed as you go. That can open you up to a step-up basis increase when you pass away. So there's a lot of angles to approach this problem. And what I think can really get people hurt is that they don't think about this soon enough. And by the time they do, they've really run out of options. And there's some other ways that this can happen too. There's really no perfect scenario. I'm not trying to say that there is, but only that you got to think ahead. You know, if you've got highly appreciated real estate that you've depreciated a lot over the years, then that's a potential tax bomb as well. Or if you're a business owner and you're going to exit, you should be thinking pretty far. Once you realize that you would want to exit, you should be planning on how to make that happen in the most tax efficient way possible. And if you take a step back, I'm talking a lot about taxes, but what I really am focused on here is flexibility. Having the flexibility to pull money from different sources, depending on what's the most advantageous way, not only from an investment standpoint, from a tax standpoint, is really critical in making your dollars last longer, all else being equal. And to tie tax diversification in with investment diversification strategy, there's a big similarity in the planning. Like, you create a diversified portfolio because you want to protect against the downside whenever it comes, but you don't know when it's going to come. So you accept potentially more modest returns in exchange for the risk management benefit of diversification. And the same thing goes with tax diversification. So let's say you have accumulated a lot of tax deferred assets. You might want to say, okay, even though I will end up paying tax on this money, I'm going to put it into a tax-free Roth account because I'm going to diversify against a future tax situation in which I'm pigeonholed and having to take money out at very high tax rates. Having that future access to the tax-free money, even if you may not need it, is a protective measure. And this all goes to say that I'm not trying to suggest that you can or should predict what future tax rates are going to be, because what if you end up in a situation where tax rates are much different in the future and it cuts you the wrong way? Well, that could happen, but it's the risk that you're taking to mitigate the scenario where you are forced to pay tax in a high tax environment and you really have no choice in the matter. And I can think of one person recently that I worked with who really did not like the idea of paying tax in the current year, hated it. And they did a great job at preventing that from happening. But ultimately, they accumulated so much in tax deferred assets that they're facing this situation where they're being pushed into one of the top tax brackets federally and into the top tax bracket in their state. And they really don't have a choice in it anymore because they've just gotten too far along. They don't have enough years left to mitigate the problem. They basically extinguish their flexibility. So when you think of tax diversification, think of the trade-offs. Think about what flexibility you potentially want versus performance versus your current tax scenario versus what you might think your future tax scenario will be, and put it all together and use that as your decision framework. And it's not going to be perfect, but if you go all in on one set of constraints and things don't turn out exactly the way that you picture, then you don't have a lot of movement once that situation becomes reality.